Hi, and thank you for joining us today. I'm Ewart Zuckerman. I'm a CEO and Chief Investment Officer of Eureka Wealth Solutions, and we'll be talking about tax planning today. So let's talk about the agenda for today. Let me start with some housekeeping. So first of all, this webinar is being recorded, so just be aware of that. We'll be using recording to post it probably on YouTube. And we'll definitely make it available to anybody who was on the webinar or who registered or who is interested in seeing it. Also, just for compliance purposes, I have to say that this webinar is for informational purposes only. It does not contain any individualized tax, legal, or investment advice. Again, this is just for your information. Um, and also, we're planning to do this for about an hour. I may have to skip a few parts because the presentation is probably longer than that. And I will leave some time for Q&A, although if you do have questions, during the presentation, just feel free to type it into a Q&A box, and I'll try to answer them as we go through this. Um, So that's the bit of housekeeping. So we'll talk about expectations, what you should be expecting from this webinar, and we'll talk about the three big questions about tax planning. The what is it? We'll talk about some concepts and naturally misconceptions about it. We'll talk about the when and the why, and then we'll look at four or five, depending how you look at it, sort of groups of strategies that are involved in tax planning that will cover what you see listed here, from capital gains all the way to business strategies. And then we'll talk a little bit about my company, Eureka Wealth Solutions, and what it does and how it can help with some of the aspects of what we're discussing. And then, as I mentioned, Q&A. All right, so without further ado, um, let's take a look at the expectations. So first of all, this is not a master class. Just want to put that up front there. Um, it's been popular over the last few years to have a master class concept where somebody can learn from an expert on everything about the subject. This is not it for a number of reasons. One, I'm actually not a CPA. A little bit more about me later, but I run a wealth management company. Two, I don't think there is a single CPA out there who knows all the strategies that exist. And even those that are experienced will not be able to teach you even the crux of the major ones in an hour. In fact, there are some strategies that I will be discussing that may take an hour by themselves and probably won't be enough. So this is a big overview for anybody who is investing or is a business owner to understand what this subject matter covers. So you will definitely see some specific examples. We will definitely look at a number of different things that many investors or even some of the financial professionals that you may have talked to are not even aware of. And so the idea, what you should be taken away from this is that you need to understand whether your situation is applicable to some of those scenarios that I will be talking about. And you will need to understand that if it is, there are most likely multiple solutions that can help you lower your taxes based on a variety of factors. So that's the goal of today's presentation. All right, so let's talk about the what. Tax planning is not tax preparation. Let me start with that because this is probably one of the biggest misconceptions. Um, Tax preparation is what you typically would hire your accountant for. And this is the procedure of preparing and submitting all your tax returns to the IRS and various states and potentially local, like in New York City, tax authorities by their respective deadlines. Um, that's obviously good, and some people actually do it themselves, and some people hire professionals, but that has nothing to do with tax planning. In fact, what you're trying to do there, what your CPAs are trying to do there, is actually filing those taxes based on the various numbers that they get from different forms. Um, you are not actually trying to plan in advance to pay lower taxes, which is the purpose of tax planning. And the goal, by the way, is not to pay no taxes. That's one of those probably impossible goals. But the goal is to reduce your tax bill and reduce it meaningfully. Um, so there's a quote from Benjamin Franklin. Chances are you may have seen this before. I am generally a big fan of quotes. Smart people said smart things at some point in time and make them applicable to a number of different things in much fewer words than other people can express it. So this is one of those quotes that enhances my point, and this is the way I like to use them. And I apologize if I overuse them. So continuing on that subject, here's another quote. And some people would say this is probably the smartest man that ever lived. And if he 75 years ago found US income tax code complicated, you can probably get my point. So what are we trying to do in terms of tax planning? There are four groups of strategies that will proactively help us reduce taxes in the future. Um, those strategies revolve around either large transactions that you're looking to make. These could be anything from buying or selling a house or a vacation home or any other kind of real estate. It could be a luxury car, could be any car for that matter, could be any other transaction that deals with either in your personal life or that could be considered as an investment. But generally, there is a different group of investments and obviously different types of investments and different types of strategies revolving around that. And then, of course, if you're a business owner, there are all kinds of different strategies for businesses. And we're mostly talking about small businesses here. In fact, we primarily focus on professional offices, offices like dentists, doctor offices, financial services offices, legal offices, and the likes. There is a number of different strategies that those business owners are probably not aware of, or maybe are aware of, but are not sure how to implement them. And so that's a big group as well. And the last one is estate planning. And this is also including any kind of long-term planning, which goes into potential retirement, into potential succession planning of business, as well as estate planning, as in what happens after you leave this world with all of your assets. So, what is the tax planning process like? This is how we typically get started. We would review your taxes for the past couple of years, and we would identify missed opportunities. So you would actually see, or potential mistakes as well. So you would actually see some of the things that you could have done potentially that if you work with us before, and something that you could look forward to in the future years. We would also project your income for current and next year because that will help us figure out the taxes based on what the income looks like. And then we could identify and apply potentially multiple strategies and hopefully prior to the year end. I'll talk a little bit about that in the when question. And then, of course, we will review the tax forms and we will ensure that we file the strategies according to what we're trying to do, in which case we would actually work with you or your CPA, whoever is filing those taxes, to make sure that the proper forms are used and and they're properly filled out. So one other quick point to make here is that remember that tax planning is unique to each individual. It should follow from everything I just said, but it's something that you should be aware of. Even though there are multiple different strategies, what happens with your life dictates the specific strategy for you. So when should you use it? Again, keep in mind this is a rule of thumb. That does not necessarily mean this is true for absolutely every case, but this is typically where you would need to look at potentially doing some tax planning. Case number one, if your capital gains are over 100,000. Again, this is arbitrary number, but it's a pretty good gauge of what we're talking about. So if that number is over 100, take a look at some strategies. It's going to be worth your while potentially because you will be saving more in taxes than your time and your commitment is worth. Business owner, again, if you have ordinary income over 500, it's definitely worth to look at some tax planning. With the estate tax, if you're over exclusion limit, then that's also a good case to do it. If you're not sure what exclusion limit is, chances are you don't need to worry about it just yet. As far as timing, so it's better to look at tax planning before certain things. I cannot overestimate this or overemphasize this enough. Before you're considering large transactions, you may want to look at tax planning before you make big decisions about your life, moving to another place, buying or selling a business, buying or selling real estate, even potentially things like a marriage or divorce, any other number of different things, big decisions in your life, you may want to consider tax implications. And then, of course, before the end of the year. Chances are you probably have heard this from your CPA. I wish you told me before the end of the year. There's nothing I can do about this. Like, this is very true, and a lot of CPAs, especially those that are good at their job, they know that, and they try to help, even though they may not specialize in tax planning. But there are certain strategies that are probably good for almost anybody, as long as you do it before the end of the year. Once the calendar year is over, there's only maybe two strategies that I can think of that you could still apply. Those would be opportunity zones that I'll touch on in a minute, and also contribution to IRA or Roth IRA that you can still do after the year end. But those have potentially limited impact on your taxes. It's always better to look at it before the end of the year. So again, a quick point to make here, tax planners are highly qualified and educated people with multiple licenses. They're not just CPAs. We work with a lot of people with master's degrees and even PhDs and multiple licenses. Some of them have legal license as well. It requires quite a bit to be able to do this and to do this right. And again, like I said, all of this is a rule of thumb, but certain strategies can still make sense even outside of the above guidelines. And I'll probably start with some of those. But before that, let me just answer the question, why? This is probably the easiest of the three. Why? Because it's complicated. Because the tax code, as of the last count, contains over 74,000 pages. This is just the federal IRS tax code. There is a number of major law changes that happen all the time, and they affect all kinds of taxes. So this is a list of just over the last 7 years of 5 major laws that have been passed by the US Congress that affect a number of different aspects in personal, business, and estate taxes. It's worthwhile to say that just in the last year, there's over 300, 300 new laws that Congress passed that affected taxes in some way. Most of them will never touch your personal taxes um, because they're relatively small and very specific. But that is to say that things change constantly. And these laws come with all kinds of specific rules and limitations and defined timeframes and caveats and exceptions. Um, and of course, you not only need to understand the provisions and the expirations and potential future changes, um, which one of those laws could be overturned, which one of those laws could be extended or changed, and which way. Um, it takes planning, for lack of a better word, to be able to stay on top of this. And this is the last quote for today, I promise. This one comes from the Supreme Court Justice, former Supreme Court Justice William Rehnquist, um, who basically puts this to rest. This is one of the questions that we constantly get when people look at some of these tax strategies, and the first thing they say is this legal? Because some of these things sound like some sort of a scheme. They're not. They follow the specific rules and laws that are currently available. And this quote tells you that the IRS code is exactly what drives this, and there is nothing illegal about it. Any strategy that follows that code that allows you to save on taxes is legal by definition. Um, so, bottom line, what you need to take out of this is if you're looking at this, it takes a team of professionals. It's not going to be one or even two subject matter experts who will take a look at it and will say, well, you need X, Y, and Z. You probably need a team. This is one of the laws from the previous page, secure, and it actually is an acronym, secure. And this is 2.0. The 1.0 was first passed back in 2017. This was passed in 21 or 22, pardon. And these are just some of the things that it allowed. I am not going to go through this. These are just headlines. There is literally dozens and dozens of different tax implications of this one law alone, but it had a very significant impact on tax law and, by extension, on the way that investors and business owners manage their taxes. So we'll start with the first group, the investments. Taxes on investments. This is, by the way, one of those flow charts that we often utilize for our clients. They are sort of the first approximation of the answer to a number of questions that people have. And this flow chart in particular is saying, am I going to pay taxes on the sale of my investments? And it just basically takes you through a number of questions that you can answer yes or no to, and you'll see the answer. Chances are, if you've been investing for a little bit, if you have a sale of investments and it's not done as part of your tax advantage accounts, and your cost basis is lower than the value at which you sold it for, meaning you have a gain, chances are you will be liable for some taxes. And then it takes you through a number of different things, depending on your income, depending how long you hold the investment, type of investment, it's a dividend, whether it's a capital gain, and so forth. But this is the first start. So at this point in time, you're getting close to the end of the year. You should probably know if you have any of those investments that you've sold, or that maybe your advisors or your wealth managers have sold for you. And this is going to be your tax liability going to the end of the year. So what can you do about it from the tax perspective? Well, a few things. So the first one is a strategy that most people are familiar with. It's called tax loss harvesting. The idea is relatively simple. You have some capital gains, so you look at some of your unrealized gains, unrealized losses rather. So anything that you have paper losses on. You bought an asset, let's say it's stock at $20 and it's now 18. So you're down on it. Until you actually sell it, you can't realize the loss to offset some of your capital gains. But if you're looking to do that, you can do that before the end of the year and lower your tax bill. These days, a lot of this particular strategy is actually built into various software. You have different brokers, online brokers that help you implement this. In many cases, it's even free. Some people can use a robo-advisor that actually has this technology now. So one of the questions you may have right away is, why are we even talking about this? This is simple, and I don't need anybody else to do this for me. Well, actually, it's not that simple. There are multiple caveats. First of all, any software or any broker tool that exists will only be aware of your current capital gains and losses situation in that specific account. If you have multiple accounts, you really need to do this across multiple accounts. And if you have gains in one account and losses in another account, you may want to look at all of them combined, because that's how the IRS will look at it, which means it may not be beneficial to you to reduce your capital gains in one account if your other account has losses that more than cover. In addition to that, you may have an issue with the wash sale rule, which basically says that if you sell something at a loss and you buy it back, or buy substantially the same security, which is the legal language, back within 30 days, then you can no longer write it off taxes. And software may not necessarily catch that, especially if you are buying it in a different account. So you need to be aware of that. And then on top of that, it may not even be beneficial in your case. What do I mean by that? You may have carried over significant loss or significant loss, most likely from last year, in which case it will be applied against your capital gains this year. In this case, this may not be in your best interest to even use this strategy. This is something you would need to look at and know with your tax planner to understand whether it makes sense at all. In addition, your own situation may be different depending on what it was last year or this year or what you anticipate next year. If your income is going to fluctuate depending on where that is and where your other assets are, and also what you expect is going to happen to the tax brackets next year. If you expect taxes to go up or down generally, or if you're planning to move to another state which will have different tax structure than yours, or you expect your income to jump or drop, all of those things may affect whether or not you actually need to do this. So even with that relatively simple strategy that's available elsewhere, you really want to be able to look at the whole picture. And these are just some of the considerations I mentioned. All right, moving on. The other strategy for capital gains. This is one of those strategies that's been set up by Tax Cuts and Jobs Act back in 2017. That is set to expire in 2026, but now with Trump back in power and Republicans running it, chances are it may be extended in some way, shape, or form, although, again, nobody knows exactly. And this is one of the strategies that allows you to defer your taxes on capital gains for a number of years, but as of right now, for at least 2 more years. So this is also one of those strategies that I can do a whole hour webinar on, and will probably not be enough. So I'll just do a very high level overview of that one. The idea of an opportunity zone is that there's over 8,000 those zones that have been designated across the US. Each state had the opportunity to do this. And what it is an area that was lacking funds to be developed. Sometimes it's just a hard place to develop because of the terrain or because of the social-economic characteristics of the place, or sometimes it could be actually up and coming place that was not getting enough investments. And so once those opportunity zones are identified, a company can start or continue real estate projects within those zones, and they will get a number of tax advantages, and investors can use them to defer their taxes. So the rule is you can use almost any capital gain, just not the dividends, but capital gains from the sale of securities, from the sale of collectibles, from the sale of real estate, even if it's your primary home, for example, from sale of business that rolls into your personal taxes, and a number of other different things. You can use that, and you essentially roll it over within 180 days after you realize that gain into an opportunity zone. And you can then use three tax advantages. One is you defer taxes until December 31st of 2026, or until you sell, whichever comes first. And like I said, that 2026 deadline may now be extended potentially. You also have a step-up basis for capital gains. What that means is that those capital gains that you're rolling over, so let's say you are looking at $100,000 of capital gains this year, you can roll it over into an opportunity zone, essentially take that $100,000 and invest into opportunity zone, and you hold it for 5 years, you get a 10% tax reduction on those gains. In addition to that, if you hold it for 10 years, then any gain in the actual real estate opportunity zone investment becomes tax-free as well. There are a couple of caveats again in certain states. Fortunately, New York is one of them, and California and New Jersey is not, where some of those things may not be applicable to the state taxes. But that's a caveat that you need to be aware of. So that's the capital gains. And again, the rule of thumb here is 180 days after you realize the gain, you can still defer the gains. All right, so real estate. This is the next group. We'll talk briefly about the 1031 exchange. This is probably the most common one in real estate. And the 1031, by the way, some of these numbers that you probably see, like 1031, 721, or 529, or 401k, all these numbers, in case you're wondering, are coming from their respective section of the IRC code, which is the Internal Revenue Code, and that's just easier to call them the same because they refer to that section. So the section is 1031, and basically what it says is, if you are an investor in real estate and you're selling it, you can defer the payment of capital gains taxes on it if you then invest the proceeds into what they call a like-kind real estate. So in other words, let's say you had a rental home that you had, and you just sold it for $500,000. You can take that amount, and actually slightly higher. The devil is always in the details, and you can put it through the 1031 exchange, which I'll explain in a second, into another real estate that is similar type. In other words, again, a rental home. And then you don't have to pay taxes on until you eventually sell that, and you get out of 1031 exchange. In theory, you can keep doing this in perpetuity and keep tax deferring for a very long time. So the value of the replacement property has to be greater than the value that's sold within certain parameters. And you have to invest basically all of the equity proceeds from that. So if you had a 500,000, you can't keep some of that. You basically need to invest over 500,000 into the next property. There are a couple of other caveats. There is about the debt. There is also something called a QI, a qualified intermediary. So the law specifies that you have to go through an intermediary, the so-called 1031 exchange, to actually do this. There are a number of reasons for that. A lot of it is legal, a lot of it is procedural, because you need to somebody to actually oversee the investments and all the caveats that go into the buying and selling a property, and to make sure that everything is filled out correctly. There is one additional vehicle that exists. It's called Delaware Statutory Trust, which allows multiple investors to own fractional interest in a single property. So what that means is that in my example, instead of just buying, let's say you sold it for $500,000, and now you're looking to invest into an apartment building that has, multifamily, let's say 20 apartments, which would be substantially more expensive. But through the structure of DST, you can join a bunch of other investors like you to invest in a fraction of that property, and it would still qualify as 1031 exchange. And then finally, the most important thing to remember about this is the window that you have to actually do this. And the rule is you have 45 days after the sale of your property to identify a replacement property, meaning say, this is the one that I'm looking to roll this amount into. But then you have 180 days, 6 months to actually close the transaction. And that's because everybody knows real estate is not usually being bought and sold overnight. It takes a lot of paperwork, it takes inspections, it takes a lot of legal and tax work, which is why you have all this time. So this is the 1031 exchange. And again, if you have any questions, feel free to type them in. I'll take them as I go through this, or I can take them at the end. So I know we have a lot to go, and we have limited time. So I'll try to be brief on some of the other strategies here. So this particular strategy, for real estate, is called cost segregation. This is mostly done for commercial buildings, although if you are buying a private building that you're renting out, this is also applicable. And this strategy deals with the notion of depreciation, which is an accounting term that basically describes the method of how the costs is allocated over the useful life of an asset. Typically, straight line is being used, although there are certain other methods, which obviously I'm not going to go into too much of accounting in here, but basically just says whatever the useful life is in number of years, you divide that by the total cost, and this is the straight line. This is how much you can depreciate every year. So, for example, if you buy a commercial building, this is the number that IRS tells you. you have 39 years of useful life. After that, it's basically written off to zero. Residential buildings, 27 and a half. How many people knew that? But for personal property, it's only 5 years. So uh, this is the um, strategy of reducing your taxes. The building that you're buying, the real estate that you're buying, includes a lot of other things. It could be a garage, it could be wiring and roofing, flooring, it could be equipment, it could be a driveway, it could be all kinds of different things that will have much shorter useful life than the actual building, which means look at all these things that could be in there. Even things like a refrigerator or a dishwasher that you're buying with the building, window treatments, stove tops, security system. All of those things have their own useful life, and they're definitely less than 27 and a half years or 39 years. Um, and most of them fall within 3 to 5 years, which means if you break those out, you can typically depreciate anywhere between 25 and up to 60% of a given building. Some of those are as early as 1 year, and almost all the things that you see on this diagram within 5 years, which, as you can imagine, saves a ton on taxes. And this is one of the most overlooked tax strategies. And this could be the difference between whether the real estate investment makes sense or does not. Of course, if you do this, you guessed it, before you make your decision to buy that real estate. So I'm not going to go into other real estate ideas right now, but believe me, there's a number of others. So what we want to do now is look at the long-term goals that usually lead into your estate planning as well. So that includes these types of goals that you can see on the left side. There is typically retirement planning that just about everybody wants to do. College planning, usually for your kids. Sometimes it could be for your grandkids, could be for yourself as well, or other members of the family. Those are significant expenses, and I teach a separate webinar on college planning. So here we'll just briefly mention it. And then, of course, estate planning, health planning. This could be based on any specific needs that you may have, whether it's disability or certain conditions, or just for basically getting older, or maybe caring for your elder parents. And then, of course, large purchase. Some of them we've talked about before, and charity donations if this is important to you. So, and of course, this is an incomplete list. We actually have a master list of goals that has, 50 or so. But these are some of the more common ones. So one of the first things that you look at in terms of tax planning for these is you look at various tax advantaged accounts. These accounts are specifically designed by the IRS to help you achieve some of those goals, and this is an easy place to start with. So the first bullet point, 401k, 403b, and 457, these are various types of plans, corporate and non-profit and government ones, the three versions of retirement account that has significant tax advantages. Then the next bullet point, these are individual retirement accounts, and they're obviously different. An inherited IRA specifically is something that you probably can inherit from either your spouse or your parent, or sometimes others as well, that have different rules as well. The third bullet point are just some of the examples for business, small business retirement accounts, and again, they all have different caveats. The fourth one is specifically designed for college saving. 529 plan is the most common one, but Coverdell is another one. UGMA, UTMA are used for gifts to minors, something that you can save, help save for your minor children or the minor family members. HSA is designed for health savings, and donor advised funds is designed for a tax advantage charity donations. So again, in the interest of time, I will only look at some of the examples. So typically, the long-term tax considerations that you would be looking at is you would need to understand your current and future income. It's always a projection that you have to make, and obviously, those projections will adjust as you go through, next years. Even more so, looking at your current and future spending projections proves to be a challenge for a lot of people. And again, you have to rely on the data you have right now and change the data as you go through this. Future tax rate assumptions, that's another tricky one. And of course, rate of return assumptions. It's easy to say, oh, stock market on average gives you 10% a year, real estate about the same, bonds give you 5% a year. And then, of course, all of that is good until the year when all those returns are down. And that's what you're relying on. So you have to have some return assumptions, and that's why it's a long-term consideration. And of course, longevity assumptions. Nobody knows how long they're going to live. There are some actuarial numbers that we can use. We typically like to get these numbers higher because, well, let's face it, people live longer, but also nobody wants to run out of funds in retirement or even run out of funds that they set for specific goals in retirement if it's not just, their retirement. So those assumptions are also a little touchy, but they have to be made because somebody who plans to live to 120 will probably need somewhat different planning than somebody who plans to live until 85. And yes, of course, these have to be taken into account. So, like I said, I'll try to speed through this so we have a little more time on other subjects. But these are some of the popular retirement accounts. Like I said, those slides are going to be available to you. You can look at them before. There's a lot to take out from here in terms of cons and pros. But this is the difference between the traditional and the Roth versions of the IRA and the 401k, which are the two most popular vehicles for saving for retirement. And one of the common strategies being used with those accounts is to roll over from one to another. This ugly looking chart gives you an idea of some of these accounts, which of them can be rolled over into which. And as you can see, it's already a head spinner. There's a lot of things going on here. And why would you want to do this? Well, again, because different accounts have different features, you may want to look to maximize tax savings for your specific situations. Some of the rollovers could make sense to you, might not make sense for your neighbor, and vice versa. It all depends on your specific situation. But this just gives you a quick view of how complicated it can get. Oh, and here's another chart of 401k plan conversion. So if you do have a traditional 401k, and most people who have gone through their career would probably have one or two dormant 401ks. We have clients who have half a dozen. These are 401ks that are left at the previous employers. And the question is always, do I keep it there or do I move it? And if I do, move it where? How do I roll it over? There are all these different options. And this is just the first guideline of what you can do and whether or not this could make sense to you. Obviously, you want a professional to take at your specific situation, but this will get you at least on the right track. By the way, for our clients, all of these are available. So just ask if you'd like. This is one of the most common uh, strategies with regards to retirement account conversion. This is a Roth IRA conversion from the traditional to the Roth. The biggest reason you would want to do this is the Roth IRA. Once you end up withdrawing money from it, which hopefully will be in your retirement, those withdrawals are completely tax-free. This is one of the reasons to even have the Roth IRA. You can also watch the money grow tax-free, and it can do that for longer. Meaning, if you have a traditional IRA, once you reach age 73, you have to start taking the so-called required minimum distributions. By the way, the chart here says age 72. It changed to age 73 2 years ago, again, with that secure 2.0 legislation that I mentioned before. So it's now higher. Eventually, it's going to be even higher. But as of today, from all of your IRAs and 401ks, you have to take 4% of the value of all of that every year. It's mandated by the IRS. The idea is that you've saved all this money for your retirement, and the IRS wants you to start taking that money out. The problem is, if this is your traditional IRA or traditional 401k, you have to pay taxes. Also, if somebody inherits your IRA account, this is the inherited IRA I mentioned before, they have 10 years to effectively liquidate that. And again, they would have to pay taxes from that, unless it's a Roth IRA. In case of Roth IRA, they don't have to liquidate it. And in fact, they can hold it indefinitely, and they can even pass it on to their children. And them to their children. As far as this is concerned, you can accumulate money there tax-free, not only growing tax-free, but even at the time when you're ready to take money out, it's going to be tax-free as well. So Roth has a lot of advantages. The biggest disadvantage is if you do this conversion, you have to pay taxes now, which is obviously something you want to plan for. So that's the analysis that goes into it, and there's a number of different moving parts. I don't want to spend more time on this, but this is the crux of that Roth IRA conversion. And this, as I mentioned, this is the very high level of the flow chart that tells you whether or not you should even consider it. But again, it will depend on a number of different specific items in your situation that we will have to answer that question. There is also something called backdoor Roth IRA. So Roth IRAs are popular because of all those features I just mentioned before, but you cannot contribute to it if your income is over a certain limit. And you can see on this chart where that limit is. Even though it's being adjusted every year, for high earners, it's not a possibility to contribute directly to Roth IRA. However, what you can do is contribute to a regular IRA, which does not have a tax limit. It does not have an income limit. It only has a limit on your income where you can write it off taxes for the current year. But if you're looking to contribute to Roth IRA and you can't because of your high income, you can contribute to a traditional IRA and then immediately convert it into a Roth IRA. And this way you're contributing to Roth IRA. There's still a question of whether or not are you paying taxes on that. And again, this goes into the details. You could be paying slight taxes on that, but it could still be worthwhile to do it. But especially if you're not paying any taxes, it's effectively a direct contribution to a Roth IRA, which is something that I personally do, and I do recommend it for a number of clients, and we've been doing it for many years. This is one of those loopholes that's available. There's also something called mega backdoor Roth IRA. Similar idea, but instead of using the IRA account, you're using your 401k account. So that old 401k that you have, you can roll it into a number of different accounts. Remember the chart I mentioned? One of them is a Roth IRA. So similar idea. You have to pay taxes usually with right now, but that becomes completely tax-free as a Roth IRA account going into your retirement. All right. Other rollovers. Those are relatively complicated. They have to do with different types of um, annuity contracts in the first case. The other one is also kind of similar, which allows you to use HSA within your IRA. I'm not going to go into too much detail. If you have, let's say, an HSA, or depending on if you're worried about R&D rules, the QLAC could make sense for you, but they're fairly complicated. The third one is one that could be relevant to some people. This is again one of the new laws that was passed in Secure 2.0 that says if in your 529 college savings plan you saved up more than you ended up spending for your beneficiary for their educational needs, you can do a one-time $35,000 conversion of that from that plan into a Roth IRA account that I just mentioned, owned by the same beneficiary. So if this is your son who is graduating and you still have money in that 529 college savings plan, you can take money out and pay taxes, or you can contribute $35,000 to their Roth IRA without paying any taxes. So that's definitely an interesting option that's now available. All right, moving on to charity planning. So this is another one of these, rather than a flow chart, we have a checklist that basically says if you're serious about it, these are the different things you can look at. I'm going to try to skip this for now just for the sake of time, but if you're interested, ask me questions or let me know even after the webinar. We'll go through some of this in more detail. But these are the 2-page checklists that we use for that to get started. And some of the strategies for charity planning, I'll just briefly mention. So the bundling, this is the idea that if right now the IRS code allows you to write off your charity donations, write them off your taxes if you use itemized deductions. If you don't, you're basically limited to what you can do. So one of the strategies is if you don't have enough charity donations in a year to make sense for you to do itemized deductions, you bundle them and you do it, let's say, every other year or every third year, where you donate in a bundle, and that will get you over the hump of using the actual deductions and itemized deductions, and then you can use charity planning for. The other relatively simple strategy is, instead of donating cash, donate your appreciated asset. So if you bought a stock for $10, let's just say you paid $10,000 for it, and now it's worth $50,000. If you sell, you owe a lot of taxes on that. If you were looking, for example, to donate $50,000 to your favorite charity this year, you can donate that stock, and this way you don't owe the taxes on the appreciation. So this is commonly done, but again, usually most charities will accept that, but usually it will have to be at a certain level where it makes sense for you and the charity. But this is one of those strategies that you can do. And then there's all these other ones. So you may be familiar with some of them. QCD, I'll mention that on the next page briefly. CRT, Charitable Remainder Trust. I know some of you are familiar with that. Charitable gift annuity is a slightly different, uh, well, technically different way of similar strategy. They all come down to the fact that they're designed as a type of trust that leaves some for your charitable beneficiaries and leaves some for you or your other beneficiaries. And that shields it from a lot of normal taxes. And then, of course, there's donor advised funds. So we work with some of those. The idea of those, they act as if private funds like hedge funds, except instead of investing into assets on your behalf, they actually invest in philanthropic causes. But they do it at the with additional level of tax tax planning and tax strategy for you. So usually, if you use one of those donor advised funds, they have a large number of choices that you should be able to choose from to donate your funds to different philanthropic causes. And at the same time, as I said, they will manage those tax planning much better than you could by doing a simple donation from yourself. And this is QCDs. Just again, so for the purposes of saving a little bit of time, I'm not going to go into too much here. But again, this is one of the more common and more, unfortunately, complicated tax strategies that will help you save on taxes if you're serious about charity donations. And the last workflow the last flow chart that I'm going to show you here that deals with DAFs. And again, it's a question of should I use it or just give to the public charities? This will give you a fairly quick, dirty answer by just going through that flow chart. And so to finish up with the strategies here, top 9 business and complex strategies. Again, I'm not going to do all of them, but the blue ones deal with businesses, and I'll use those as examples. So captive insurance. This is an interesting strategy that where most insurances, especially professional offices insurance, professional offices have to take out some sort of in professional insurance for doing business. It's for usage of their office, it's for usage of their tools and equipment, it's for malpractice, and for a number of other different things. And those usually constitute significant expenses for the business owner. So the idea for captive insurance is basically creating a privately held company, a separate business that your business, such as, let's say, a dental office, would actually hold. This way, it's a separate company that has the risk, but then your company pays the premiums to that captive insurance. And that premium is tax deductible, and it's not counted as an income for the insurance company. Hopefully you got all that. So again, it depends on a number of different things, mainly on the size of the business that you have and the size of insurance that you have. But if you're looking at long term, if you're planning to open an office or you have an office and you're looking to keep it for a number of years with your practice and you're looking to grow, that's one of the most interesting strategies that you can do. And of course, you would need a team of professionals to help you set this up. But overall, over the years, it saves a lot of money. And the other business strategy I want to mention is the section 127 and 132. Again, these are IRC, the Internal Revenue Code code numbers, rather section code numbers in the code that help you with education assistance. They provide tax-free tuition assistance and tuition reimbursement in case of 127 and or student loan repayments to small business employees. So if you have employees and they have and they're going to school or went to school, or their kids planning to go to school. These are the types of assistance programs you can set up that will be compensation to your employees that will be that will have a tax benefit to you as well. So again, something your business can consider that most business owners are not familiar with. I'll quickly run through some of the other ones. So the covered call option strategy, this is something where you can use stock positions if you're planning to hold the stock for longer uh, by selling a call option against it that will generate income and will reduce the tax um, on those sales. Um, Something that very few people use, that don't always work, and again has a number of caveats. Don't always work in terms of situations, but it's one of the strategies that you can employ. The others are specific to certain investments in real estate or IDC in terms of investments in places like um, oil land or any other land where minerals are being extracted. 721 exchange is something that is similar to 1031 exchange. So this is also used for real estate investments. The difference is instead of selling your property and buying another one in 1031 exchange, you actually sell your property into an exchange. So the 721 exchange actually buys it from you in exchange for your shares in the exchange. So you have an ownership interest. It becomes similar to a real estate investment trust where you own shares of that, which in some cases could be more beneficial than 1031. Again, depending on the specifics. And then finally, the last three have to do with estate planning, and again, very specific to your specific situation. And I'm not going to go into too much detail, but again, these are we're still only scratching the surface. Some of the strategies are still relatively well known. There are dozens, if not hundreds, of others, depending on your specific situation. And so, for those who are not familiar, let me introduce us, Irrevocable Solutions. We're a fiduciary, we're fee only RIA. We specialize in thematic and impact investing. We also do personalized financial planning, as well as tax planning and estate planning that we do through our third party partners. We also help manage corporate 401ks and 529 college plans. And we have access to a variety of alternative investments. We work with a number of small businesses, as I mentioned, a lot of professional business offices, such as dental and medical and legal and financial services. We also help with 401k plans administration. We can help small businesses with funding and services like franchising, for example. Um, we are also, as part of being involved in impact investing, we donate 2% of the fees that clients pay us to the choice of charity, the client's choice of charity. So that makes us somewhat different than probably any other RIA or wealth manager you've seen out there. And we know that what we're dealing with is individuals. Almost everything that we do is very personalized, hence our tagline, one size fits one. We know that we're dealing with specific situations and we do solutions for that specific individual. Also, as part of our community outreach, we've been an associate partner of New York City Football Club, proud associate partner for the 3 years running. And so just a word on how it works in terms of tax planning services. So This is not something that most wealth managers or money managers would provide. This is not what most CPAs would provide. What we do is 4 different tiers of different service. And as you can see here, the starter is basically digital only investing option that we have. The plus is adds advisor interactions and many a la carte services. Power includes full financial planning, and super is the one that includes full tax planning. And all of these are tiered, just like taxes, meaning you can see the percentage of assets under management that we use to determine the price, and they go as they go higher, each next tier is lower. So what you're looking at here at the super level, effectively, we're looking at a minimum of about $500,000, which is now going up to $1 million at the beginning of the year, and there will be a flat fee for assets below that. And this is essentially what we're looking for all of the services, including tax planning. So how does this work? As you can see where tax planning fits between financial planning and investments and estate planning, if you determine that you need it, or for a free consultation to see need it, we can have a consultation with us and our tax planning team, and we can see some of the options. So analysis of your savings and costs. There's always a possibility of audit risk, especially with the more significant ones. Nobody likes audit, but most of the strategies have actually gone through other precedents where audits have been done, or even IRS had lawsuits. So there are precedents that these are valid and can be used, but there will be other considerations as well. And if you choose one or several of the strategies, the cost of the implementation will be substantially lower than the savings. So what does that mean? The implementation costs, so how much it costs to actually implement some of these tax strategies, they will go to the vendor, whoever is the company that actually will do this. There is no fee. I repeat, there is no fee to Eureka or Tax Planner. The only commitment you have to us is for the super plan to help you with your investments and your financial planning, and tax planning is included. So here's an example. Again, this is a hypothetical, illustrative example. The actual numbers may obviously be different, but let's say we go through this strategy, through this process, and we identify a couple of strategies. And we say this first strategy will save you $50,000 in taxes this year. This cost of its implementation will be 10. And the another strategy will save you 30,000 and the cost will be 5. So by adding $500,000 of AUM for us to do investments and financial planning, this is the flat fee you pay, $60 to $150. The total tax savings will be for this year $80,000. Your total cost, including all these 3 costs, will be $21,000, $250. And all the other things, investments, financial planning, access to alternatives, and all the other things will be on top, already included. So hopefully you can see that this is a no-brainer in terms of what we can do for this tax planning. But again, depending on your conditions, remember the one slide that I went over. If you think that this is for you, or if you want to try it out, we can definitely do that. But the idea is, if you're trying to hire a tax planning company, which are not very common, a lot of them, as I mentioned, are a big team that will charge per individual project. I can almost guarantee you that the costs are going to be significantly higher, but you are welcome to shop around and tell me if I'm wrong. So this is what the tax planning looks like at Eureka Wealth Solutions. So at the end of the day, Hopefully you got that. And if savings on taxes is not for you, by all means, please don't call us. Don't call us also if you think you can do this on your own. I know I can't. I don't think I've met a single person who can do all of this on their own for themselves. The tax planners we work with actually use some of their colleagues to help them with some of these strategies. But by all means, if you can do it on your own, don't call us. And of course, as I mentioned, if you can find the service cheaper or better elsewhere, by all means, please save your money. But if you can't, um, I think you're out of excuses. Just go to our website, Workable Solutions, and click on schedule your free consultation. And we'll go from there. We'll see if it makes sense for you and for us, and see if that makes sense. One last word about me. I am the CEO and Chief Investment Officer of Workable Solutions. As I mentioned before, I have over 25 years uh, experience in the industry. That includes some of the banks you recognize. Some of them are no longer around. I mean, I've left those banks, and perhaps that contributed to their demise, or at least I'd like to think that. Our company is now 10 years old. We actually just turned 10 a few weeks ago. So that's about me. And this is the disclosure that I promised at the very end, at the very beginning of the presentation to be at the very end. Again, this was not um, an individualized investment legal or tax advice. This is for informational purposes only. And at this point, I'll take any questions you may have. I know we haven't had any yet, but I'll pause here for a minute to see if anybody has any specific questions on anything I talked about or anything related. All right, I'll leave the screen on again. So this is my email. You can send it directly to me. It's Igor, my first name, Zuckerman at Eureka Wealth Solutions, all one word.com. Or again, you could just go to our website, www.eurekawellsolutions.com, and check us out and click on the button to schedule your free consultation, big orange button. You can use that. And if there are no other questions, I'd like to thank everybody who is joining us today to listen to me. Hopefully, this was informative. And if you think of any other questions, let us know. Thank you very much and have a good evening.